And we're live. Okay. All right, interesting. Just seeing how that goes out. All right, well, we'll wait for a few more people to come here, but yeah, WGS, that's kind of shitty. Shitty biotech stock, 287 million market cap, and it's up like 4x. So, like, in other words, it was like 40 million. But here's a half a billion. BLND. Don't believe I've ever heard of that one. Blend Labs. Penny stock. Recently ripped right off the bottom. It's been choppy since. Stay away from it. And that's it. Amazing morning with zero opportunities. Yesterday was interesting. Let me take a look at some stocks people were mentioning yesterday. And perhaps, hello, Colby, perhaps something will jump out at us when we take a look at the chart. Dun, 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 dun. By the way, yesterday on the SE, my PCS, my put credit spread that I entered on April 4th at 55.30, right there, had gotten to the point of 100% max profit. And that was entered on April 4th. And it had been in the 90% for the last few days. But I hit max profit yesterday, and that constitutes a 31% return on the capital for that trade. So the capital required, 31% return. So if you got into Apple, 100 shares on Apple, and the stock went up 31%, that's what happened, okay? But what's interesting to note is that two things. One, the distance that stock went was 14.8%. So it's important to note that with put credit spreads, you get that nice beneficial descending break-even line, which gives you that padding every passing day. Should the position be not taken off or slightly going against you, helps you stay in, all that. But more than that, if it moves, however much it moves, like in this case, 14.9%, my return was 31% in the same amount of time. So you get more reward for less risk. So really good there. And then the other thing is that, by the way, 31% return in that amount of time, which was 25 days for the trade, 25 days for that trade to gestate. 31% in 25 days, if you reallocate that and just keep going and going and going with it, the annualized performance of such a gain is 5,035% gains annually. So like that's a trade, that's a 25-day trade right there that's subjecting your portfolio to 5,000% annual gains performance level for less risk than trading shares. So yeah, it's definitely worthwhile reflecting on. Okay, moving down my list here. IBRX. Okay, that's more biotechy. Yeah, I looked at a lot of these actually, now that I remember. Already looked at a lot of these, but let me go from the bottom. EGY. Earnings are coming too close. It's interesting though. AAON. Aaron. Uh yeah. Yeah, that's pretty cool. Pretty nice. And 3.5% ADR, 4% lately. But earnings are in like 2 days. Nonetheless, I'm gonna put it on the hot list. That's pretty nice. Pays, pay sign. 6.5% ADR. Problem with this one is it's a little bit skippy. Like it goes broop and then it hangs out, and then broop and then it hangs out. So it makes like a 1 day blip. 1 day blip, it's got you got lots of 1 day blips and then heartache or subjecting your capital to. So you look at this chart. Let me point this out because this is really, oops, I don't need to do it like that. Look at this chart. When you really take a look at it, it only had 4 days of gains in the last half a year. So it looks like it'd be great to get in because it looks like it keeps going up and up and up and up and up. But don't let your technical analysis turn your brain into pudding. It only had 1 day there, a second day of progress there, a third day of progress here, and a fourth day of progress here. Now imagine in the last 6 months getting into something that only performed 4 days out of the last 6 months, and the rest of the time made your money sit or be subjected to drawdown. That's not good. You want to be looking for contiguous and continuous progress more than 4 days in the last. I'm literally going to count it here so we can get a percentage. And I'm being generous because I didn't count some of the prior days on this, but 174 days. So 4 divided by 174, 2% of the time this stock makes progress. 2% of the time, 98% of the time, your money is going to be sitting there. So, okay, maybe that's, advanced or slash expert, level of, thinking about how to subject your capital and trade to risk, but it counts. It's what matters. I mean, you're going to have lackluster performance if you go after stocks like this. They got 6.5% ADR, and off of the bottom here, the total move in 6 months was 182%. I mean, that's phenomenal. But are you an investor or are you a trader? If you're an investor, then somehow you figured out through value analysis, fundamental analysis, to get in back here, and maybe you made 100% in 6 months. Well, good for you. That's a different trading style. All right, let's see what else is up in pre-market on our hot list. Workspace, I think no, it doesn't have earnings, but yesterday it was up big, and this morning it continues to be doing something. Big volume changes on WorkSport, actually, is what it's called. But it's still in a hell of a downtrend from $4, and now it's 59 cents. So a shitty stock. Pegasus Systems, nah. Gas, Stealth Gas. 2.4% ADR. It's a bit slow for our hot list. I think, we had it on there because it was really running at times. I think that's changed. It's become all blip and chop, blip and chop, blip and chop, and then chop and then drop. Blip, chop, and drop. So I'm taking it off the list. Boom. Bye-bye. TRML. This doesn't look good at all. That gets off the hot list. AUTL. Yeah, we'll wait for that to get hot again. This is interesting. That doesn't get off the list. It's not completely out of play yet. This looks outstanding. See, look at this. But then my earnings are coming right up. But with this kind of chart, you like a nice smooth progress. Okay, it pulled back quite a bit. However, that gave it a chance to breathe, and then now it's got this whole tightening up range. perhaps it's going to go on another run. When it goes on runs, it goes on runs, which is nice. It's about 50-50 mixed with non-useful sideways action. ADAP, it's $1.15 penny stock. SG, $25. Sweet green. This looks almost like Holy Grail. I don't know. I'd have to measure it. I don't know. Let's see. We need to find 100% move in less than the 30 days. Oh, Jim, there it is. 22 days. It did 100%. Now, since the total move, it did 142% from that low. And then the pullback looks to be pretty okay for me. The pullback retracement of the total move from low to high should be roughly under 40%. I mean, I wouldn't ignore something that's even at 49, 45% pullback. Like keep an eye on it. Obviously, a 20% pullback or a 15% pullback is way extremely strong. But anything under like 40% pullback, which if you imagine is just sort of under halfway, it's like pretty forgiving. That's a holy grail. So this one, SG, is a holy grail right now, and it's doing a fast right side reclaim. So these drops took a while, but the right side has been really fast reclaim. It's in 1, 2, 3, 4, 5 days, it's reclaimed what took 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 days. So it's reclaiming twice as fast as it pulled back. This is huge. Wish I would have noticed it here on this blue bar would have been perfect. Man, I got blue bars. I get, I'm horny for blue bar. I got to get some. We need these more blue stocks with blue bars. And I gotta wait. I gotta wait and find me some stocks with blue bars because I got blue bars, and I'm ready to get into stocks like this. This stock looks phenomenal, and probably we'll be breaking this pivot here, 2573, really soon here, possibly before earnings. And then if it does, that's a domino effect. So easy to pop the all-time high there at 2650. And by all-time high, I mainly mean recent high. It may have been higher, but relevant. It's like 2 years it's been waiting for this moment. So Holy Grail on the SG, you should always keep that on your radar. And it's too close for earnings for me to get in now as a put credit spread, and that's all I'm doing homogeneously all year. But anybody's welcome to go shares trade on this Holy Grail pick SG. It looks so good, and it would have been nice to get in. I'd say down in here. Down in this region at about 2260. It's not 25 now, but anything that's gone 100%, actually went 150%, is telling you it could do something like that. Even if it did half that, would you really be disappointed if you made 75% gains on shares on that? You know what I'm saying? So, that's quite an opportunity, SG. All right, let's talk about the market. The market this morning had a wage report come out, and wages, the price to pay, the price you pay per hour or annually for an employee remained flat. So that's good, I suppose, from a business perspective. Perhaps it depends. But the part that seems to have dropped panicked the market just a slight bit, only 0.5% drop, was that the benefits that you pay to employees have gone up. So the cost to have an employee has gone up. The cost has gone up. Good for employees. Great for them. Applaud them. Great. But that does mean it's going to be cutting into the bottom line, the margins and the profits of these companies. And so as investors, you have to adjust. You simply have to adjust. That's fine and everything. You just have to adjust your forecasts looking forward. These companies will not make as much money as before, minus some small percent amount. So how big of a deal is that? Well, the market seems to have adjusted about 0.4% down. That's it. That's it. It's over, unless it keeps riding this um, wage information adjustment down all day, which is, in my opinion, probably not what a move all day down would be coming from. It would probably be just coming from just the fact that the market is higher risk right now. So I think that's it. 0.4% adjustment in the future outlooks of these companies because of a slight increase in the cost to retain your employees and services, and that's just the way it is. I mean, in some senses, that's good. I mean, that's what everybody's been, crying about, that they should be paid more. Well, in some sense, they're not because wages are flat, but in some sense, they now are because they're getting better benefits and benefits packages and benefits and better benefit pay. RJ, there you are. Let's see. So we've got 9 minutes and 30 seconds before the market opens. And let's take a look at the market itself analysis, both the growth market, the S&P 500, and actually the Dow would be good to look at as well. So I have this underwater line in the sand here. This was the pivot that broke down, that created a breakdown in uptrend. This was the level. So this is the level to reclaim, regain, find support at, back test, bounce off of, and fly bullishly off of. And that hasn't even gotten over that yet. So all of what I just said remains to be seen. It could act as a form of resistance. And this whole area here is all congestion. This is all topping congestion. There's going to be just, you have to think of it as like all stocks just sort of try clamoring. If we really are going to go bullish again at some point here, let's say that's the prognosis, then all the stocks, all 500 on the S&P 500, all 100 plus on the Nasdaq, the Dow, plus anything else that's doing decent, they all have to clamor for positioning. So you have to think of it as like I watched this like fast motion view of all stocks in the stock market during the pandemic when it happened, and it looked like if you had ripped a tree trunk out of the ground and it had clods of dirt on the roots, and then you just shook it, and like all these stocks just started falling off, and the strongest stocks like hung on for dear life, and then you shook it again, and then those fell off a bit, and then you just keep shaking and they fall, right? So in some sense now it's the reverse in this situation. All these stocks now have been shaken just over the last 3 weeks, right? They've all been shaken to their varying spots. Now what's going to happen if the prognosis is bullish forward is they all have to clamor for positioning up there, and they have to wait for the other one to go, yeah, 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 I'm with you too, and they all have to sort of get on board, because one stock won't make it. If Apple just starts flying, you'd have to know a lot about the market, but with experience. But you would know that if the rest of the market ain't having it, eventually Apple is not going to be sustained. It doesn't matter how good of a move Apple wants to make or is making, it's going to come under fire under the pressure of the rest of the entire market. So everybody's got to start to get in concordance, and they're all going to start to be clamoring for space up in that congestion zone. They're all spread out right now into varying wide degrees, and they all start to need to get all squished up and into this area, and that's going to take a little while. Some stocks will lead and they'll do what I just said, but they won't sustain. But once everything starts to really get in there, and that might take a month or two or three, once they start to really do all their clamoring for space, and everything will start tightening up. You look at those VCP patterns, volume will be coming down everywhere across the market in all positions. That's an indicator that things are going to happen, but it also means that, see, things aren't happening yet, but that's an indicator that they will. And everybody starts to get into pole position and then behind each other, and it gets ready for the race to start, and then bam, there'll be something. I don't know what it is. Maybe the election. It could be months from now, could be weeks from now, could be in 2 days. These things could have a super fast right side reclaim, but everything needs to get up there to their breakout levels or cheat levels, and we'll be watching all that. But that's if that happens. That's the best case scenario, guys. That's the best case scenario. Let me get this little screen over here moving. Okay, but if we don't get up and over this pivot line that I drew here, what I'd call the underwater line, and back test bounce off of it with support and reflect and go back, what I'm talking about is like this. In theory, this is not exactly how it would happen, but something like this, and then we come back and bounce off of support. That's what we're looking for. If that doesn't quite happen like that, and it falls back through, we're going to be in for a prolonged situation that could continue to get worse. In fact, it might not be over for a long time. This move from here to here, that might be the only rally we get for the next 3 months, and then maybe there'll be one more that breaks out and goes to the top in like July or August, and then reflects back, and then you come November and there's the election, and then finally we break out. How many rallies is that? 2. And that's the prediction, by the way. The seasonal prediction for election years over the last 50 years of elections where that is from this point forward, from April forward, there to be basically 2 small rallies that last like 2 weeks, maybe 3 each, coming off of the bottom of a very rough patch. And yet all of what I've just described is fine. There's nothing bad going on there on the market. This is absolutely great. We had to wait last year, 4 months from July to the end of October, November, before we started to get our signals and things took off. And it's just the way it is. Making money on the stock market is also about not risking it until it's time. It's about being patient. And it's about waiting for your moments. So we'll know better, as things start to sketch themselves out. But I already pretty much have a pretty good idea of how the rest of this year is going to go. And then we'll probably get a Santa Claus rally at that. So anyway, all right, we've got 2 minutes. I almost said hours. 2 minutes until the market opens. And does that all make sense, you guys? Like, did you comprehend the whole kind of forecast there and kind of understand what's going on and how you should be risking your money or not? How you should not be risking your money. Now, the way I'm getting through all this is I've got put credit spreads, and I even got iron condors, and I've got call credit spreads too. I've got my portfolio nicely hedged. I got positive trades, I got negative trades, bullish. I got long, I got short, I got bullish and bearish trades and sideways trades all over the place. But they're all spreads, which is very nice because I'm basically taking the 2/3 side of the bet, whereas other people are taking the 1/3. So the odds are in my favor, and that's got me flat and up for the year. But the last, I would say month, I've been roughly flat, slightly up. Yesterday was a beautiful, beautiful day for my port. One of the things, Randy Winkler, you might notice is that at the end of the day, sometimes your options spreads will get stuck at the end. The last blip, right at the close of the day, they'll get stuck in a really weird bid asks, because of the liquidity of those options just got a little funny. And that can cause your balance to reflect incorrectly. And so just only with years of experience or just knowing that, me mentoring and letting you guys know, can you really know that you should just look at these things, go through the chain, see if something's mechanically messed up or something, to know whether or not you should be worried. You should take the portfolio level or the gain or loss for real or with a grain of salt. And that can happen. I'm in so many positions. I've got two of those positions that are doing that, and then like midday they stabilize. So you gotta watch out. You don't want to have stop orders in per se, but you want your take profit orders you can always put in. I mean, hell, if it accidentally moves in your favor, you'll take it. All right, market's opening in a few seconds here. Let's see what we got. Bing, bing, or ding, 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 ding. Hey, did you hear that Tyson and Jake Paul are going to fight on? I think it's July 20th. I think it's a Saturday. I think it's July 20th, and it's going to be a professional fight, 8 rounds, 2 minutes each, and it's going to count professionally. It's not going to be an exhibition fight. I think that's cool, but a lot of people are saying they don't like the fact because of the 30-year age difference. I think Tyson could fuck that kid up either way. I don't think the age difference is. I mean, look, if Tyson beats him, age difference, schmage difference, right? If Jake Paul beats him, that's what Tyson wanted. He wanted to fight too. I mean, it takes two to tango. So that's the way it would go. But uh I believe that too, RJ. I think Tyson's I don't really think Jake Paul is ready for this level of fighter. I mean, he's like a seasoned veteran. He's like Rambo. It's like if you could have the best Navy SEAL, the best Delta Force, the best, Green Beret soldier, by competition in the field and find out who that was, and that person could go relatively undefeated. And then all he did in his retirement years was keep his training up and keep himself in shape and keep himself a solid, chiseled, fucking number one top performing killer. I mean, I don't think Jake Paul's prepared for that. You know what I'm saying? He's going to come in there and also, I don't think that Jake Paul's ready for the endurance that Tyson can go. I think obviously he's a young buck versus old seasoned veteran. It's kind of great. He's the wrong guy, frankly. I don't think Jake Paul's the best heavyweight opponent on earth. So that's why I think this works. It's like Tyson's just gonna go flick, and he's gonna go boop, and fall down like a matchstick. But you know what? I hope it lasts a while, and you know what? It's going to be goddamn entertaining. I hope it's entertaining. I hope it's entertaining. That's one of the problems with Tyson fights. That has to be probably the only complaint there is when you buy a Tyson fight. Because I grew up on Tyson, and one of the most disappointing things was how fucking good he was. Because there were fights within 22 seconds, the fight was over. Round one, bing bang, 22 seconds, bam, and it's over. And it was like, big $100 million fight. Tickets, sold, like that's it. You got 22 seconds of thrill ride. Just not enough. So that's the only complaint with Tyson is it could be over too quick. So I'm kind of hoping that Jake Paul can last only for that reason, so that I can finish a fucking bucket of popcorn or something or charcuterie or whatever I'll have in front of me. All right. Well, anyway, let's see what we got. It looks like from the open. Look at these lists. Look at these meters here. Look at these lists. From the open, we're basically flat with growth picks, if not slightly red. Now on the market itself, the market is actually green. It's retracing quite well. We've got 5 minutes candle being put in right now. So if anybody wanted a 5-minute breakout signal on any stock that you're watching, it's going to come in a moment here. And what was I going to say? And pick wise, I don't really see anything. Maybe it says Nvidia is doing pretty well off of the open. Eli Lilly, one of the strongest performers on the S&P 500 this morning. That's because I had really good earnings results, and it looks like it's creating a never look back. That's an entry on Eli Lilly. That's a double entry signal on Eli Lilly, and I'm going to go look at the options and see if they're worthwhile. I actually think they're not. It's probably going to keep me out of this trade. I have a feeling. Let's see. Whoa, the liquidity on the options, like if I go down to the 20 delta, it's like a 35% bid ask spread. So boom, exactly what I thought is okay. Wow, I just got a fill on Kava. That's great. Thank you. What do I have any more contracts out there? Okay, so we are at the 50% profit point on Kava. That bling was me hitting the 50% profit point on Kava, the automatic order that was in there. Look at that. We got in right here. Now, does that happen every time? No. But is that why we get in? Yes. Is that the signal? The entry signal, is that what it's supposed to signal? Yes. Does it happen every time? No. But the reason why we go PCS on these things at that moment is to save us the heartache of when it doesn't. But think about it this way. Look, I got in here at 62.50 with my capital, right? On a 25% return on capital trade, which just triggered at 50, what is it at now? At 56%. It's up 56%, which means my max profit of return on capital of 25%-ish is at about halfway, 12.5%. It's a little bit more. So let's call it 13%. So I've got 13% gains on my capital right now in this trade, 1, 2, 3 days. But the move from entry 62.68 to here is, well, actually, it's about the same. So I'm probably going to see even further gains here, but it's about 15% as well. The point being, we're not missing out on any gains when you go with a credit spread. A lot of people will say a credit spread's like a slow way of making money because they don't understand credit spreads. They're thinking more of like iron condors, which are very, very sideways and don't make money when things move around. They make money over time. Whereas a credit spread, like a put credit spread, that's a bullish swing. That's a bullish trade. The nice thing is, though, you're making money every day when it doesn't work out, in addition to if it does work out. You're taking the two-thirds side of a three uh, possibility trade, which is up, down, sideways. When somebody buys an option and they go long on an option, they're betting the stock will go up. If it goes sideways, they start losing money every day. You ever notice that, guys who trade options? When we sell the options, we're making money on the 2 out of 3 ways the stock doesn't go, which is down and sideways. We're making money on those. And if it goes up, we're making accelerated money. Or I don't know if I had that backwards when I just explained it. I had a couple things I was looking at, a little bit distracted. All right, so that's Kava. Kava's doing great. You guys who share trade and look for breakouts, that's a breakout also. I don't know if I would take it there. After the decades of experience, I don't know that I really love risking flat breakouts like that. I love getting these cheat entries, like here. I love getting cheat entries. It's in day trading with a blue sky situation, maybe it's an IPO recently in the last 6 months, and you get the new all-time high breakout, and you got a blue sky with high frequency trading for intraday day trading. Yeah, maybe breakout can really fly, and then you just scalp it and pocket the gains. But with stocks on the day-to-day basis, on the daily chart versus the market and industries and sectors that they're in, they have a hard time continuing unless everything's in alignment. So anyway, there's a lot of arguments to be made for getting the credit spreads versus getting shares. And yeah, there's a lot of extra moving parts and stuff, but it's worth learning. It's kind of like the evolution. I think it's the modern evolution of the trader. Um, because you can make more or the same for less risk. And it happens to allow you to stay into the trades longer where they may work out even work out, whereas with shares, they would have kicked you out. Okay, moving on. Let's see what else we got here. So Lily's not at the top of the list anymore, but GLW's even stronger. All right. Corningware. So GLW must be short for glassware or something. And it's 1.7% ADR. Now I'm not gonna for shares traders, that's too slow. But I'm not gonna let it deter me from checking the liquidity of the options. That can be perfectly fine. That it's all relatively speaking, it's proportional when you do the spreads. So let's take a look. But I doubt it. I doubt they're liquid enough. I just need to know. Okay, so 2,500 options have traded so far. If I go down to like the 20 delta, yeah, the spread is about 40%. So that's not conducive. That's not conducive to good things here. The move that GLW is making right now is 3.7%, but its projected volume on the day is kind of average. So there's many reasons why we stay out. Those things that I look at, the relative volume, the blue skyishness, the catalystness of something, the options liquidity, the contiguousness of things, the ADR percent, all these things, you know, put you on the right side of getting into something and the right side of not getting into something. You don't pay attention to that stuff and you're just going in blindly after things that because you're just candlestick trading or getting things off of moving average bounces or resistance, support, and resistance zones. It's not enough. It's not enough. You could put together a lot more thesis to get better results. All right. Continue to let me know anything else. Wing. It's got earnings coming up tomorrow. Let's see. Tomorrow morning on Wingstop. And that's one that I'll be interested in getting in tomorrow if it indicates. Let's check out our hot list. We have so many lists, beautiful lists with um, tickers, opportunities to go through here. There's just so many charts to look at. W, Wayfair, no. Work, sport, we looked at it this morning, no. But the volume is going insane on that, by the way. This is coming off at the bottom for you penny stock traders. Wow, it's like 70 cents. Maybe it's going to get up to $1.20 in the next week. Zebra, 2.8% ADR, $321. Yeah, that's just not in a bullish formation enough. TT, Google. I'm going to take a look at Google in one sec. TT, this chart looks great, but it's a 2.4% ADR. It's not good for shares traders, but take a quick look at the options. I doubt it because it doesn't sound like a popular name. Yeah, 104 options traded. That's not going to work, but I'm not just going to blindly leave it. I'll go take a look at the 20 delta, and if it's tight, no, it's not. It's a 40% spread. So there you go. The system works for itself. It keeps you out of trades you shouldn't be in. All right, Google found a little support down here. I was thinking that I should have gotten a call credit spread at the never look back top on this red day on Google at the end of the day, and I missed the opportunity. But I also feel like Google can change gears pretty fast, and all it wants to do is be a bull, and it doesn't. They have all the resources in the world to manipulate and get the press out there to put a good story out on Google and keep things turning around and bullish on it. So I don't think going bearish on Google. This is a good idea. Even though, normally on a stock that some things are just too big to fail, but on anything that's, normally not that big, you probably could take that as a never look back call credit spread, bearish trade off of that earnings release. NXPI is the number 4 performing stock in the S&P 500 right now this morning. It's with you VK Snapchat at the top of our growth list for how it's performing off of the open. All right, so now if the liquidity could match and everything could line up, this could be a good put credit spread, and this could be a good shares trade as well. 5.24% ADR. 20. Okay, we get the 18 delta. Things are pretty tight. The 25,000 option spreads have traded so far. Options, not spreads, options. Okay, I'm clicking on things and it's not working. There we go. Now for an 18% delta, I would get a 19% return. And I don't like how Skippy, I mean, Snapchat has really looked great, but their options are just not divided out such that they're providing the a trade that's conducive for spread trading. It's just too illiquid. And you'll get that thing that I was talking about this morning where, your trades are going to fluctuate. Your spread gain loss is going to fluctuate. Let's see. It's going to fluctuate throughout the day, and at the end of the day, it's going to fuck around with your liquidity. And you get margin called in some situations. Should you be right on the edge of your margin call, and that's the way you're set up, and then you're getting into stocks like you haven't made the adjustment to how you select stocks yet for that liquidity issue that I was just talking about, and you will discover, oops, that was a bad idea because all of a sudden you're getting margin called for a situation that isn't even a situation, and I got to liquidate something in order to meet the margin call, and it starts to put you through hell. And what if you get 2 or 3 of those happening? You have 50 positions. Uh, yeah, so it's an important what's the word, habit to get into. COHR. This is coming up about as fast as it came down, so it has not strengthened at all. We have other greens from the open that open down, but they're green off of the open. So some of those are worth checking out, especially the most green one. So that'd be Duolingo. It means it's open down, but come up with strength. Okay, no. And let's see, Marvell Technologies. I got an iron condor on that and it's playing right into it, but no, that's not a signal. Micron. Are you still in Micron, Randy? Or did you reset your whole port? But are you still in that Micron trade? Because it's coming back up. It's getting there. GPS. Yes. Okay, good. What are you at? Like negative, pretty close probably. Negative, I don't know, 65%. Uber. No, no signal on Uber. Uber just continues to just go straight down. Wing on to Carl. Good morning, buddy. You missed a couple of penny stock ideas. I know. So I think, correct me if I'm wrong, that you like those things. 97.5 divided by 95 plus 30. So you got the 97.5, 95. Yeah, I understand that. So you're at plus 30%. You shouldn't be positive. Oh, you have a call credit? No, hold on. Okay, we need to go back on that. What was that stock? Something's wrong with you on that one. Marvell? What was that? What stock was that? Moderna, by the way, and look until you can tell me, I'm going to be looking at other things. Moderna's got earnings coming up. We got Apple coming up this week as well, Monday. A lot of these stocks look great. They're just the earnings are coming right up. Some of them look really great. Once earnings are behind us, for the season is over, there's like all these trades we'll be able to be in. The wonderful spots where we have a clear one runway. What was that stock, Randy? Fix. Micron. Okay, let me go back to Micron. Oh, Fix looks. Hang on, let me just take a look at Fix for a second. We just had earnings on Fix. Okay. Yeah, we'd have to wait for it to get over 324 because that definitely acts as a catalyst. They never look back high, red panic drop type day on Fix. Well, anyway, the options might not be liquid enough, but if it were to get over 324, that could be a shares trade or potential options trade. So I'm going to put a little marker there, turn on the alert, boom, bam, and then alert line, boom. Love those. Alkite. Alkite. ALKT. There we go. Let's see. Micron. No, it's not ALKTs. No. What do you think was so 90? What? 7. You had a put credit spread on Micron. So you changed things or something? Or what did you do? You had a put credit spread on Micron that was like 125, 120, I think. Yeah, that's probably what it was. The 125, 120 way up here. Yeah, it was a mistake. So you probably closed that out, if you remember. That was a mistake. And so you probably closed that out. I'm going to change that to very lightly colored so we know it's closed. But you're saying you have a 197.5. Okay. When did you open that up? Can you right click on that? Click view trades and let me know the date and time you got that. The date and time on Micron. Okay, in the meantime, let's look at some other potential picks here. Some of my watch lists are not computing. I'm not sure why that is. I could clear the memory or something here. Select garbage. That's Thinkorswim's way of clearing memory. Yeah, I don't think that's really going to change things though. I'm going to try flipping to something else and then coming back. Yeah. There we go. Yeah. I don't know what the problem was. All right, EOG. What's the date and the time on that, Randy? On that Micron. EOG, no. 28%, not that big of a deal. Whoops, lost my volume. There we go. NXPI 3M probably reported. Okay, here's a little screenshot. Okay, that's good. Pops it up in a different way now so I can really see it. The 25th, kind of like morning-ish. Okay, so we go back to Micron. I copy paste your previous one. 25th is right. Oh, you just got in just a couple days ago. Okay, that's interesting. And the morning-ish, probably down here. And was that the May 17? No, the June 21. Good for you. Good job. June 21, and that would have been the 197.5. So down here for 60 cents. So your break even is 99.40. So there we go. Change the color to a little bit more solid since it's active. That's your trade. That's looking good. Now I can see why you're up 30%. Now, I wonder if you should have even taken the gains because 1, 2, 3, 30% return on capital in 3 days, 30% to max profit on your return on capital in 3 days, $60 on a, what was it? $2.50 spread is $60 divided by 190. Does that make sense? Did you follow that, Randy? Who was able to follow that? Say I with the little I. It's a $2.50 spread. You got 60 cents. It paid 60 cents. So that's $60. The spread is $250 collateral. So therefore it's $60 for $190 collateral. See, there is a shitload of stuff baked into everything that I just said. Yeah, definitely too fast. So I'm glad you said that. Do you get it now? Do you understand now, everybody? $60 you could make if you put up 190 bucks. Okay, now you understand. Yeah. So that's 31.5% return. See, I'm seeing that here. 31.5% return. Okay, now look at can you see my little, here, I'll move it over here. See my calculator, okay? But now what you could do is you put a parentheses around the 60 bucks. You didn't make the full 60 bucks, you made 30%. So you go times 0.3. So you made 30% of the 60 bucks. You don't have to worry about what that is. Let's say it's 31%, it's some weird number, okay? And you can't do it in your head. Obviously 33% would be 20 bucks, but it's 19 something or whatever. But because it's still divided by 190, that tells you how much actual return, not max profit, because you're 30% to max profit. But your $60 divided by 190, your return on capital, should the trade work out all the way to 100% max profit, is 31.5% ROC. Okay, you guys minds are going to be blowing here because you got to keep all these numbers in your head. In other words, the trade itself could make 31.5% return on capital when you put it on. 60 bucks for $190 for every $190 you put up. 31.5%. That represents 100% of what you could make. It's called max profit. All right. You're currently up, let's call it 31% to max profit. So like how much is that? We don't know. It's $18.6 out of the 60 times the number of contracts you have. If you have 10 contracts, it's 186 bucks, whatever. So we take the 1860 and divide it by the $190 that you put up, and we get you're up 9.7% on your capital. 9.7% on your capital. So did you follow that? And so that's it. Like, we could stop there or we could keep going. The interesting thing is that if you're up 9.7% on your capital in 3 days, that's insane. So now this you might have to take notes on in order to do this, but if you take the square root of the third 1/3 power, if you put that to the power of 1/3, it'll reverse compound it back down to 1 day's gain. So in other words, if you put something to the power of, let's say you have a gain of 10%. On your capital, that number in itself is 1.1. That's 10% gain on your capital, 1.1. If you put that to the power of 2, if you got 10% for 2 days in a row, and you put that to the power of 2, then it compounds it for 2 days. It does 1.1 times 1.1 because 10% on 1 is 1.1, and 10% on 1.1 is something more, like 1.21 or something. Probably is exactly that. I'm not sure. But the point is, by just putting it to the power of a number, it compounds the return for you mathematically. So I'm just giving you like shorthand math here, like the kind of math you should have been taught in school, not here's how you do square, like logical thinking, practical thinking math, using powerful math, complex, but logical and practical, right? So if you want that to compound for 2 days, you do to the power of 2. You take the return and put it to the power of 2. But what if that was your return for a week? The number 1.1, and you put it to the power of 2. Does that mean it's for 2 days? No, it's for 2 weeks. That would give you how much that return projects out for 2 weeks. So you have to keep in mind what you're compounding. Is it per day? Is it per week? Is it a monthly figure? Whatever, okay? So if it was a weekly figure and you compound that 52 times, you get your annualized return on that kind of a gain. The performance that you're getting on your portfolio for subjecting your capital to that kind of return in 3 days or whatever it is, and you compound that out to a year, you'll get the annualized return. So check this out. So if you think of it in reverse, if you wanted to get 3 days of compounding gains, you raise to the third power, then if you'd like to know at 3 days, if this is the gain you're at, how much is that per day, reverse compounding back down to a single day unit? Then you just do one to the power of 1 over the number of days. It's just a fraction. It's the inverse. The inverse compounds it back down to the single, it divides it into 3 days of reverse compounding, sucking it back down to the original amount of gain per the single unit of 1 day. Okay. So I think that makes sense. So here we have, you did 9.789% return, for example, at 31% max profit on your capital. Now, what you got to do though is you got to add 1 to that, so that if you're going to compound it, it has to have a 1 in it. So that way it represents 109%. 0.789, right? 109. Now, if I said, okay, how much is that in 2 days? If I kept getting that every day, in 2 days, that'd be 20.5%. It starts compounding out. You have to have that 1 on there. It's important to just put the 1 on there. I can explain that right now. That's just kind of like mechanics of it. You would find out for yourself that things were fucked up if you didn't put a 1, because if now you're at 0.978 and then you do that to the power of 2, you're going to get a smaller number, 0.0095. You're like, wait a minute, what? I thought if I made 9% per day in 2 days, I'd make more. That's because you compounded the number without the 1 in front of it. So it needs to be like 1.1. And it's not. So you have to add the 1 in there as a matter of just bookkeeping, good bookkeeping on your gain. So now you have the number 1.09789. Now, if I take that to the power of 2, now I've got a 20.5% gain in 2 days. But this wasn't in 2 days. This gained 9.7%, which comes from the 31% max profit of $60, is across 3 days. And I want to know how much is that per day. And what I'm telling you is you can put that to the power of 1 over the number of days, which is 3. And that will reverse compound it back down to its per day gain that it's been compounding to get to this point. So it's an average, and it's 1.03. So in other words, 3% gains per day compounded for 3 days will equal almost 10%. It was 9.7%, right? But here's the really cool thing is, now that you know what you're getting per day, we can go and we can say, how many days am I staying in this trade? And you can say, okay, until expiration was 57 days. I'm supposed to be in this trade for 57 days. I mean, that's the option you bought, right? And to get to 100% max profit, which is $60 on $190, I'd have to wait theoretically the whole 57 days, theoretically. And in that time, in 57 days, if I achieve that $60 out of 190, that is 31.5% return. Remember, we did that math earlier. I'm not just coming up with that number anywhere. Do you remember? $60 for 190 bucks in the end will be 31.5% return on your capital. Okay. Now, 31.5% return on your capital. Now, in just 3 days out of 57, you've achieved a third of that. As it turns out, you've achieved a third of that in 3 days. In other words, 54 days left to make the rest. But in 3 days, you did a third. So 54 days is the rest. So the question is, in 57 days, if you kept up this rate of return that you've been getting for the last 3 days, if you were to close out this profit now and nail it down and say, I love these returns, now let me go put this money somewhere else and get the same thing again, how much would you have made in 57 days if you kept getting this same return every day for the next 57 days? In other words, at this point, what kind of performance improvement are you getting? If you set it up to make 31.5% gains in 57 days, but in 3 days, you're now up almost 10%, how much more than 31.5% in 57 days is that? Does that project out to be? And if it's a big number, you should probably close that trade out and take that profit and relocate it. Let's see. So we take that we reduced down to a single day. We take that number because now we hold the power of a single day's return, which is 3.16%. We've reduced it, recompounded it back down to a single unit of a day. And now we raise that to the power of 57 days. And we get, you have to subtract one when you're doing percentages. You get 490% returns. So in other words, you're getting 490% return instead of 31.5% right now. So you absolutely have accelerated gains going on. And you should close that trade out. I mean, it's like, this can happen the next day. If you get in, it can happen the same day. If you get into something and you get in for 50 days, our average goal is 45 days to expiration, right? 30 to 60, somewhere in there, erring on the long side. 45 days to expiration. If in one day or even the same day that you get in, the stock performs super well and you're up 25% to max profit. So you're 25% of the way to your goal in one day out of 45 days. Like, just logically, first of all, don't you understand that that's way better than what you were supposed to get? Because like if you got 25% return every day for the next 45 days, you could retire a billionaire, right? I mean, that's subjecting your money to incredible gains. What's more important to realize is that the next day is likely not to be better. And so what that means is that if you hold the next day, now you're not getting as good of a return on your money in the long run as you did the day before if you closed it out. Kind of weird. You could make more money that next day, but it would, let's say, be a smaller amount, which is more likely. And now the average return daily that you subject your money to in your account has gone down, and that's not good. And so anytime you have a good profit in a single day or after a couple of days on a trade, it's more important for you to just close it and take it and flatline your account and wait to put it on something else that could do the same than it is to hold on for another little bit more gains, because what you're doing is you're stunting your annualized performance of how you put your capital to work when you don't close accelerated gains. So anyway, by the way, the annualized return of that 3% per day is probably off the charts. It wouldn't even compute. I mean, getting 489% in 57 days works out to, in 1 year. Well, it's not that big. It's 86,000% return per year. I mean, sometimes the returns we get, the accelerated gains we get, are so big. There's like, it's a bigger number than number of stars in the universe. It's off the scale sometimes. You absolutely should take the profit on that, probably. But not if not if it's you should be an intraday trader about it. Like, you should press your wisdom of the way things move to its edge. Don't just be like, all right, then I'm taking it now. watch it. Like, what is this now? Micron. Like, look at the chart on Micron. Notice it's in an uptrend, high, low, higher high, higher low, higher high. Let it keep doing that until some point in which are ready. You could get out now. I mean, it's obviously, the interesting philosophical thing to realize is that the highest point that you get out in your portfolio will always be the highest point in your portfolio. So if you think of it less of, I need to ride this fucking stock to the tippy top, and more of, I simply need to allocate my capital in my portfolio into magical things, magical fairies that make it go up. And every time it goes up, I just move it over to something else that's an opportunity because that one thing worked out. I just move it to another thing. Every time, if you stop thinking about it as stocks and more like how your portfolio is performing and how you're managing your portfolio, then any gain is a good gain. Getting out at any point is the highest point in your portfolio. Any point you get out in your portfolio, when your portfolio is up, your portfolio has achieved the tippy top. You could never be wrong. And that's why just go ahead and taking the gains is, never wrong. And even if price goes back on you and you go ahead and take the gains and you were up still, you're still up. You're working your portfolio. Don't sweat not getting the tippy top on a stock. Be happy that the stock moved up. It doesn't matter where you get out at that point. It worked, right? And now you got to move on and go again. You got to think of it more as about managing your money uh, than anything else. Oh my God. You didn't record this? Oh boy, you really forgot that one day. Yeah, this was a master class. Maybe I'll cut that out and I'll post it on YouTube in a little bit, okay? All right, you guys, let me work on that, I suppose, and having some breakfast. And there you go. Any questions? Any tickers you want me to look at? Any questions? How's the market doing? The market's going sideways on the day. We don't care. We're hedged. What do you guys want to talk about this week in class? It's in 2 days. It comes right up. It's always so fast. It comes up so fast. Probably more about, hedging, probably, just so you guys, I'll probably also looking at stocks and finding opportunities and having the confidence to not get in and know when to get in and all that kind of stuff. That's probably some of the stuff we'll talk about. But all right, you guys have a great morning. Stay safe out there. Stay smart out there. And I'll see you back in the group. Bye bye now.